morning, Namibia. Welcome to Breakfast with FLI, a show where we discuss financial topics and where we feed you with your business financial breakfast. I'm your host, Diago Manyangapo, and in today's discussion, I'm joined by Mr. Arinze Okafor, a Chief Investment Officer at Mopane Asset Management and the founder of the Namibian Investment and Finance Academy. He is a former part-time lecturer at the Namibian Business School, where he taught fixed income, equity, and portfolio management to MBA students. Mr. Okafor is a qualified CFA and CAIA charter holder, and he also holds an MSc in Investment and Finance from the University of London. In today's discussion, we are going to talk about investment and gaining insight from his extensive expertise in the field. Good morning, Mr. Okafor. Welcome to Breakfast with the FLI podcast.
Good morning, and good morning to your listeners and viewers.
Thank you.
Very excited to be here.
Thank you. Investments seem to be such a complicated term. Can you just kindly take us through what investment is and give us an overview of the Namibia's financial landscape and its key players?
No, thank you very much for the question. So, what is investment? So, in simple terms, it's a process of allocating capital, or in easier terms, money, to either assets or financial security with the expectation of generating a return, preserving wealth, and many a times to generate income. So in terms of Namibia's financial landscape, so Namibia, though being a small economy, is quite well developed, especially when you compare us to a lot of other countries. So the industry is dominated quite a lot by large commercial banks. So they are the key players, your FNBs, your standard banks, your net banks and the likes, and Bank2. But also you have other players that are very key towards the financial sector, which is like your central bank, Bank of Namibia. You also have then NAMFISA. So Bank of Namibia regulates all of the banks, and then NAMFISA regulates the non-banks, like myself. So then you have the asset managers, which is like us, Mopane Asset Management, MOMI, and some of the bigger asset managers like your N91. And I think to tie it all together, or last but not least, then you have your insurance companies, like your Sanlam and your Old Mutuals. So we have quite a diverse set of financial players within the financial system, and they all play a unique role in terms of investments.
How has the Namibian financial landscape evolved over the years in terms of investment opportunities?
No, thanks for the question, and thanks for putting me also on the spot to potentially give away my not too old age and neither too young age as well. Namibia's financial sector has evolved quite a lot. For those of us who may remember in the early 90s and the late 90s or early 2000s, Namibia's financial system was dominated pretty much by your large commercial banks, and then obviously your government bonds, and to a large extent real estate. And I think the reason for that at that time was because of our underdeveloped financial market. So a lot of our investments were placed in South Africa. So then we moved on into the mid 2000s to late 2010, where we had a lot of financial sector reforms, the introduction of NAMFISA as well, and to a large extent also the financial sector strategy. We spoke a lot to localization. So that created or unlocked a lot of new localized investment opportunities. And also on our Namibian stock exchange, we started to see more listings. Then if you go now to the period of, from your late 2010s or recent, you've seen a lot of development, much more listings, and as I mentioned earlier with the localization, a few more opportunities for local investors to put their money. Also, what we've seen quite recently is the recent developments, obviously, with oil and gas, green hydrogen, but also the large development of private equity and all of it. And just for your viewers listening, so private equity, some of us actually do it, but we don't know that we're doing private equity. So if you invest in your friend's business, let's say a hospital or a clinic or a pharmacy, and it's been running for 2, 3, 4 years, the moment you are putting money into that entity, you're putting money potentially buying equity, hoping that that company will do well and reward you later with shares or dividends. So that is almost like private equity in an individual capacity. So that is an investment opportunity that has picked up quite a lot in recent years. And last but not least, what we've also seen is a lot of opportunities are unlocking in the innovation and fintech space. So you've seen a lot of now the importance of financial inclusion, which I think FLI is a key player and trying to bring more services to the unbanked. So I think recently MTC has launched MTC Buys, which are one of the platforms that are trying to enable, financial services, especially to the unbanked. So there's been a lot of developments and investment opportunities in that space.
You spoke of private equity. For someone that's looking or for someone that is considering investment, what are other formal investment options available for them?
Okay, so I think, it's a good question. So there's formal, because private equity is more alternative. So your formal investment options, it typically starts from your bank deposits. Like when you're with any of your commercial bank, there's a fixed deposit, you have a call account. That is typically where people start. I think we've evolved from the era of putting money under the mattress, which is unsafe. So that's typically your first, let's say, exposure to investments. Then the second one is your government bonds and treasury bills. And for those that don't know, it's also accessible to individuals. The central bank has done a lot of hard work to try to create access even for smaller investors. So for the viewers that are listening, in the past, you could only buy a government bond if you had 50,000. And treasury bills, I believe, started at 10,000. But now Bank of Namibia has launched like retail bonds, which allows you and I to buy the same, units of a government bond and get the same returns. So that's now the second stage. So as you know, with life, the older you grow, and same with investments, the more you go up the risk spectrum, the more risky it gets. So the third one is on your stock exchange. These are shares, just like Standard Bank, MTC. So obviously they're also good, but also have its own risk profile. Then you now move on to unit trusts, which most of us may be familiar with. So unit trusts, it's also available at your commercial banks or with your asset managers like, Old Mutual, N91, and the likes. So for the viewers listening, unit trust is almost like a pool. So it just combines all of those assets I've mentioned now. Your fixed deposits, your government bonds, your treasury bills, and your shares. So it gives you a flavor of everything. So it's almost like a pizza when you put all of the toppings together. So then that really, one can say, is the formal. So when you mentioned with your question now on private equity, that moves more into your alternative investment opportunities. So what you will begin to hear a lot is private equity and venture capital. So for those listeners, venture capital, again, it's just a very big fancy word. But for some of us, you have done it, you just didn't know you were doing venture capital. It means if maybe Rosalia presents a nice idea to you and you like it, but you believe within you it's going to work, but it's not yet been proven. So that's a very early stage investment. That's just a fancy way of saying venture capital because I believe in your idea, and sometimes I can even get more shares in your idea because you are still at the beginning. So that's really venture capital. Venture capital is you really come in at the very, very early stage of an investment opportunity, while private equity, you come in slightly later. After Rosalia has now started making money, 3, 4 years, she's looking to expand, getting more people. That's usually the time private equity likes to participate. And the last one in terms of alternatives. So you see now, even agriculture is an alternative form of investing. Whether you're a farmer in livestock or you are in crops, I think we all suffer from the same thing, which is climate and drought. So I think that in a nutshell covers your formal investment options to your alternative. But I think the key thing to mention there is each layer you go is relative to your risk tolerance.
Like Mr. Okafor said, we have quite a few investment products available in the market that we can consider investing in. Mr. Okafor, tell us, are there risks or what are the key risks associated with investing in the Namibian market that the Namibians should consider?
Yeah, no, thank you for the question, Rosalia. And I think with anything in life, like life there's ups and downs. With investing, there's also risks. So I think the first ones that immediately come to mind is the first one would be liquidity risk. So what that means in simple terms for our listeners is how easy is it for you to buy and sell? That's what liquidity means. And in terms of investing, so as I mentioned in one of the earlier questions, so though our market is well developed, it is still quite small. So to give you a practical example, you are able to buy shares on the stock exchange, but sometimes, depending on the size, it's not so easy for you to sell it immediately. So that's what we talk about when we say liquidity risk. The second one, which is not too major for us who invest locally, is a currency risk. But also on the stock exchange, you do have your dual listed, which means it's listed here in Namibia, listed perhaps in South Africa on the Johannesburg Stock Exchange, or listed anywhere else abroad. It's only at those times do you then have currency risk. But I think the most pertinent one that affects us all is inflation. So why is it important? So inflation affects what they like to say is your purchasing power. So in investments, especially those who invest in fixed income instruments or your money market instrument, this is a very key risk to be mindful of. Because if your return is less than inflation, that eats into your pocket. So what we like to term it is your real return. So your real return is the return you get from your investment and the difference between that and inflation. So if it's positive, then you mostly have good investment. And why that's so important is obviously for fixed investments, your returns are fixed, and then if inflation goes up, it will start to meet those returns. And I think our central bank has done quite well over the years to increase interest rates when they see inflationary pressures coming through, and that has always kept, at least in my memory, inflation down to single digits, I think, since early independence. So those are the major ones for your traditional investments. But as I mentioned earlier, with the evolving opportunities for those who invest in agriculture or renewable energy, and those obviously have sector-specific risks. Like if you're in mining, it's commodity prices. Commodity prices go up and down, so that's a key risk factor there. And then the rest, it's agriculture. I think I've shared it recently. It's climate, it's drought. Yeah, but that's in your alternative space.
Mr. Okafor, I'm just wondering, comparing government bonds, and how do we compare government bonds and private investment options in terms of risks and in terms of returns as well?
A very, very good question. So government bonds, as the name suggests, is an investment instrument that is backed by our government. So when you buy a government bond or a treasury bill, because also it's a government instrument, you're backed by the security of the Republic of Namibia. So what that means is, even as an individual, how government funds our roads, our hospitals, and some of the projects is technically the government is borrowing money from us. So I think that's a key lesson in terms of what the government bond is. So it provides very stable returns, and it's usually relevant for investors with a low risk tolerance, those who just want something stable and sort of guaranteed. That is what a government bond provides you. And also for an individual, it's tax-free. So to give you an example, some government bonds, it's called a GC50, for instance, it matures in 2050. So the interest or the coupon you get there is about 10.25% per year. So some would like to say, will I be alive, by 2050? I think it's a good question, but the point is, it's an instrument that, gives you very much a peace of mind. And year on year, you're getting that 10.25%. So for a lot of us who are entrepreneurial, sometimes you ask yourself, what investment can I participate in that gives me 10% or more per year without doing much? So a lot of our other investments is stressful. It's day to day. They give you more returns, but more stress. So a government bond is typically quite safe. In terms of the private options, which we spoke to earlier, which is like your shares, your unit trusts and the likes. So they give you higher returns, but also come at a slightly higher degree of risk. So you see, once you invest in the stock market, there's multiple factors that can affect your returns. So global news, so you may be investing in a share, but what Trump is doing on the other side, or what's happening in our neighbor, it can affect the share price. So that up and down movement is what then causes some volatility, which is the risk. But with more risk, the normal principle is that there's higher returns. So the biggest difference between government bonds is government bonds are stable and are very good for conservative type of investors who don't like risk. In Afrikaans, they say bankdruk. So when you now invest in shares, it's good for investors who want to ensure that they are generating returns above inflation and also higher returns in general. And it's good for investors with a higher risk tolerance and a longer time.
It seems there are considerable risks associated with some of our Namibian investment products. And as someone that's considering to invest in the market, you should as well know the risk associated with the products. Ms. Okafor, how does the Namibian financial sector ensure that there is investor protection and that the risk is mitigated?
No, great question. And I think to alleviate the fears of the listeners, I think that's why I say, like, life is up and downs. So the risks are part and parcel of the investments. So the risks really apply depending on which investment product you go for. There's very little risk, if at all any, if you're investing in money market instruments. There's literally no risk of capital loss. So when you invest in a fixed deposit or any money market instrument, treasury bill, what you put in, you are guaranteed of getting out. The only risk really comes with the interest rate, where if Bank of Namibia cuts interest rates, for instance, let's say you were earning 8% last year, but if Bank of Namibia cuts interest rates, maybe by 1%, The only difference is you earn 7% this year, but your capital is guaranteed. Where there is a risk of some capital loss is when you invest in shares. And as I mentioned earlier, given that shares move up and down, that is really where the risk lies. But within that risk, to alleviate the fears of the listeners, that's where the opportunity is as well. So it really comes down to what's your investment horizon and also your risk tolerance. So with shares, if you are in it for 10, 15, 20 years, you won't notice the risk much because time and time again, shares have outdone even fixed income instruments. So for those who are also planning retirement or you are young, mid 30s, early 40s, risk is not your biggest concern. What you require is return. So in terms of market protection, so we have a few entities, and I think that's the beauty of our financial system. It's also well regulated. I think sometimes for us who are the ones being regulated, we feel it's over regulation, but we must give credit to the supervisory bodies. They've really put measures in place for the consumers. So one of the bodies is Bank of Namibia, who is obviously the central bank. But then you also have NAMFISA that regulates a lot of the non-banks, which are the relevant entities that provide investment services, like your insurance, like us as asset managers. So they're pretty much on the ball in terms of addressing if we don't do what we say and keep to the terms. I think the last one that I'll mention is obviously your anti-money laundering and your fraud. I think the FIC and the compliance agencies, they're also quite adept to addressing some of these risks. And I think I'll come back again to Bank of Namibia as you've seen in the news. We always hear Ponzi schemes. I think they are very quick to identify and warn us from potentially fraudulent or investments that promise astronomical returns, but in reality it's not possible.
That was just to ensure that you are you are protected as an investor in Namibia. Mr. Okafor, you spoke of inflation having affecting our purchasing powers. How are other factors such as interest rate affect our investment decisions?
Oh, great question. And I think this one, interest rates and inflation, is very close to my heart. I think in my previous life at the central bank, I managed a government bond portfolio, but also practically, even to our viewers, interest rates and inflation affects us all. Whether you're an investor or an entrepreneur, you're making an investment decision. So if you're an investor, for us, when interest rates, for instance, are low, and inflation is high. So as I mentioned earlier, when inflation is high, it eats into your purchasing power. But when you're investing, when interest rates are low and inflation is high, the best investment opportunities are actually your shares and property, because over the long term, they generate higher returns than inflation. So you see, when you mentioned you alerted your viewers of all of the numerous risks, but it's because of those risks that bring forth these investment options that give you higher income earning opportunities. But the reverse is also the case. So in times when interest rates are high and let's say inflation is low, which I think is a scenario the central bank likes. So that's why they increase interest rates when there's inflationary pressures, and also to discourage us from borrowing. But that's actually the time where your fixed income instruments do very well. And that's the example I gave during times when the interest rates are higher. Your fixed income instruments allow you to earn the maximum in terms of your cash rates. So those are the two perspectives I'd like to give from an investment perspective. But even for the entrepreneurs, when interest rates are high, it affects our borrowing ability. So, we go to the bank or DBN or anyone to borrow money to invest into our business, to expand. So typically when interest rates are low, that is the best time to utilize debt. And you notice that it affects us all. When interest rates go down, the following month's car loan or your car installment, your home loan installment is lower. So it affects us all. When interest rates go up, we all cry. We used to have maybe a 500 or 700 extra. You buy your KFC, you buy your Galitos. But now after the Bank of Namibia has increased interest rates, you start to notice, hey, it's becoming tough. So it affects us all. So, and I think this even answers the question that you had earlier to say, what are those key risks? I think the most relatable risk to us all is the interest rate risk and inflation.
That's very interesting. Do you have any information that you would like to share with our audience as far as investment is concerned?
I think what I'd like to share is maybe some takeaways, and I think this is what sessions like this, I think, try to teach our listeners or prospective investors. Knowledge is power. And I think financial literacy, though we've done well as a country, I think there's still a lot more that we can do. And I think sessions like this also enhance that knowledge gap. So I think the key takeaway is we need to take a keen interest in information, because all these different investment opportunities, the more informed we are, the better we'll be in understanding the risks. Once you understand the risks, it makes your investment decision easier. And I like to give the example I always use the example of $100. So if you have $100, you do an assessment and say, $30, $40, that does what? It maybe sustains your lifestyle, sends your kids to school, and so forth. So that's $40. The remaining, let's say another 30, put that in investments that you understand, which is your money markets, your unit trusts. The remaining 30, with knowledge, that is where to take a risk. Where if you want to invest in the stock market, and I like to give the example, many of us, we like Swakop, we like to go to Kapana, but if you calculate a lot of those, there's not a lot of return you get from it. So that same money that gives you zero return, sometimes putting it in an investment vehicle that is deemed risky, over time will actually put you better off. So again, how will you get to that? Through information and financial literacy. The second maybe thing I would like to mention is discipline. I think discipline is quite important because discipline will also help you avoid sometimes losing money in careless opportunities like Ponzi schemes. And I want to make this more relatable to the listeners. If there was an investment opportunity out there that we could all put money in and become millionaires overnight, trust me, many of us may not be in the jobs that we are in now. We would all be there. But unfortunately, the way investments work, investments accumulate over time. So you hear about compound interest. So it's interest upon interest upon interest. That is, and unfortunately, that's the science. So there are investment opportunities out there like Forex and Bitcoin. And for anyone who's interested in those opportunities, go back to the example I've given. With your $100, if you have covered 70 to 80 of your base, that 20, that is the one you can risk on some of those type of opportunities. I think what I always caution people is invest in what you understand, and the discipline will teach you that staying in an investment over time. Sometimes you hear bad news, you call your investment advisor and say, what's happening? You want to withdraw your money, but you're withdrawing probably at a time where there's nothing wrong with the share. It's just the market, and you're pulling out your money at the wrongest possible time. So during times where there's a lot of panic, What we've seen, the wealthiest investors, that's the time they buy more, especially when there's nothing wrong with the share. And a typical example, if you're buying MTC, if there's nothing wrong with the management or the company, sometimes it's just a sector event, like COVID, where a lot of share prices went down. But I tell you, a lot of people bought shares during that time at prices that were never at those levels in over 20 years. So it shows you the importance of discipline. And I think, yeah, those would be the two key things I would share. I think there are many tips which I'll be open to obviously share on another platform, but definitely it's knowledge is power. So when you're invited for information sessions, financial literacy sessions, don't always think it's another workshop. You learn something every day. And I'm very sure your listeners have learned quite a bit during today's podcast, where we've actually realized that a lot of us have done private equity or venture capital without actually knowing that we're doing it in an individual capacity. So there's formal investments, traditional, which is your bread and butter, but there's also these emerging opportunities. And both you need knowledge and discipline.
That was such an insightful discussion with Mr. Okafor. I personally had the learning experience, and I believe our audience have learned a lot as well. Mr. Okafor, thank you so much for coming to our very first podcast.
Thank you so much, Rosalia and the FLI for inviting me. I thoroughly enjoyed this experience and I look to engage you on more of such initiatives. Thank you.